Now in basic accounting procedure, the first thing which we need to learn is the double entry system of accounting. See, this double entry system of accounting only means that we record both the aspects of the transaction. We are referring to both the give aspect as well as the take aspect. That means in any business there will be give as well as take. Give and take is part of any business. So in case of double entry, we will record both give as well as take. Whereas in case of single entry, only one of these aspects will be recorded. Now let us consider this example. Let's say there is a shopkeeper who is selling books. Now if he is selling books and let's say there is a customer who is ready to buy one of the books which the shopkeeper is selling. Let's say a customer, let's call him C1, approaches the shopkeeper, let's call him S1, and asks for a 100 pages book. Now shopkeeper from his rack gives him an 100 pages book. So when he gives him, this is called the give aspect of the business. Now the customer will in return do what? He will pay cash to the shopkeeper. That means what? On one hand, the business is giving something. In this case, it's a book. And on the other hand, the business is receiving or taking something from the customer. And in this case, it is cash. Now, when we record both the aspects, it is called the double entry system of accounting. Now, how do we actually record this? Now that we know what is double entry system, what is the process to actually record the same in the books of accounts? We cannot obviously record this in the form of sentence saying that a shopkeeper sold 100 pages book to a customer and the customer paid so much of money to the shopkeeper. This is something which we cannot do because it's tedious and it is not uniform, because there will be hundreds of transactions and it is time consuming as well. So what we instead do is we have ascertained rules of accounting. There is something known as principles or rules of accounting. So unless we understand the rules of accounting, we will not be able to record all these transactions following the double entry system of accounting. So now what are these rules? Of course, you would have studied the traditional rules in your 11th standard. So the traditional rules says there are three classifications, which are those three: real, personal, and nominal. Of course, one can follow these rules and apply them for every transaction and record the journal entry. But the problem with these rules is that it is not universally applicable, especially when it comes to transactions involving companies. Most often these rules can be confusing. What we will be doing instead is we'll be looking at the modern rules of accounting. So now what are these modern rules of accounting? So in case of modern rules of accounting, we classify them based on the nature of the account. It could be an asset. It could be a liability to the business. Of course, everything is here from the point of view of business itself. Then it could be income to the business, or it could be expenditure to the business. So based on this classification, of course, there is one more classification wherein we can say capital also, but we can include capital under liability head itself. Now, these are the four classifications in case of modern rules. So in every transaction, one of these or maybe more than one will be involved. For example, let's go back to that shopkeeper wherein he sold the book to the customer. So now shopkeeper has sold a book to the customer and received cash in return. Now, from the point of view of business, what is that we need to understand? We have to understand the sales aspect and the cash which we have received from the business. So now, what is sale to the business, or what is sales to the business? Is it an asset? Is it a liability? Is it income, or is it expenditure? Of course, I don't have to remind you that we have come across all these definitions in the first chapter itself. If you haven't looked at that chapter, I would suggest you to go back and look at the unit 3 of chapter 1 to understand all these terminologies. Now coming back, when the shopkeeper sells, his income obviously increases because he has sold something of some value. Therefore, it will add up to his sales. In other words, his income will increase. At the same time, he is receiving the cash. That means whatever cash he had, let's call it X, now will be X plus, let's assume rupees 100. He not only has X, which he already had, now he'll have X plus 100 rupees, which he received from customer 1. Now, what is cash to the business? Is it an asset, liability, income, or expenditure? Obviously, it is an asset. So, asset is also increasing. So, now this is how we will be looking at every transaction. Every transaction will be divided into the categories like asset, liability, income, expenditure, and then we will see whether that particular asset or liability or income or expenditure is increasing to the business or decreasing to the business. This is the first step, by the way. Once we ascertain this, then we will actually apply the rules. What to do if asset increases or what to do if liability decreases, that we will see in a minute. Now, before we try and understand the rules of accounting with regard to the asset, liability, income, expenditure, and also capital, first of all, we need to understand what is the meaning of the term debit and credit. Because unless you know what is a debit and credit, there is no way you will understand the rules of accounting with respect to asset, liability, income, expenditure, and capital. Likewise, we will also understand how exactly is this rule of debit and credit is derived. Now let us start with the most commonly used terminologies in accounting, that is the debit and the credit aspect. Now what is the meaning of the term debit? Now debit only means the left hand side of an account. So whatever we write on the left hand side, that is referred to as debit. In short, we also write it as DR. Then what about credit? If debit represents the left hand part, then obviously credit represents the right hand side of an account. Now, if you are referring to account, an account looks like this. This is the ledger account, also known as T account. On the left hand side, we write the debit items, and on the right hand side, we write the credit items. So if an account is debiting something, it will be written on the left hand side, and if the account is getting credited by some other account, it will be written on the right hand side. This debit and credit aspects of accounting is kind of based on the mathematics rule of LHS equals RHS, wherein we say left hand side equals the right hand side. In accounting, we do not say LHS equals RHS, but instead we say the debits equals credits. That is, the total of debits should always be equal to the total of credits.